Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Our first guest today is Simon Pressley, a regular guest on the show. Simon is the head of research at Propertyology. Hello, Simon, and welcome to the show.
Hello, Tim. Thanks for having me back in.
It's a pleasure. Now, it's a new financial year, and investors, both new and old, might be looking now to change gears, so to speak. This is typically a time which can be a bit risky in the portfolio life cycle. What are some of the common things, Simon, that you see, some of the common mistakes that investors make around about this time?
Yeah, I think you probably broke the mistakes up into two segments. One is the strategy, which includes things like the name that they might buy a property in or how they might set their finances up. So that's more a strategy piece. And the other is more how they go about selecting a property and a location to invest in. The mistakes broadly fall in those two areas.
If they make these mistakes, firstly, how do they get themselves back on track if they're one of those two mistakes? Let's deal with that first. How do they get themselves back on track? And then probably more importantly, how not to make them in the first place?
Yeah, well, I guess it depends what it is. If it's something like we discover after the event that we bought a property in one name and perhaps it would have been better buying another name, it's a costly exercise. Everything will come at a cost, I suppose, trying to undo a mistake, but less costly than if we realise we bought the wrong property, in the wrong market, and potentially the best decision might be to sell. So let's say someone buys a property, they're a couple, and they buy a property in one person's name, and they realise sometime later that it should have been bought in the other person's name. You can change that. Lodging forms with the Office of State Revenue, you're going to pay stamp duty. So you could be talking, depending on the value of the property, $10,000, $20,000 expensive, but at least you've still got the asset.
So it can be fixed, but it's a costly mistake.
Yeah, and then you need to weigh that cost up versus the benefit, to do that as well. The other one, as I said, could be, a bigger mistake is if you realise after the event that, geez, I just shouldn't have bought here at all, regardless of what name I bought that in. But that's also really, really hard, let's say you bought into a market, a good example, a recent example, if someone purchased in Sydney in early 2017 and just thought, this boom's just going to keep going forever. Fast forward 12 months, we've now had 12 consecutive months of price declines. Now, in percentage terms, that's small. It might be, greater. Sydney's fallen by about 5%. It's not a big number. But if it's 5% of $1.5 million, that's a significant amount of money. And now you realise, so I actually bought at the wrong time of a cycle. I bought at the end of a cycle, not at the start of the cycle. It might be 7-10 years, who knows, before Sydney's next growth cycle starts. And the typical property in Sydney, they're paying $30,000 a year to hold it. So they realise that, now what do you do? Do you sell?
Yeah, so I guess there are a few sort of working parts to this, and there are those considerations about what is the long-term strategy and where are you now and at what part of the life cycle did you buy into when making those decisions. So I guess that leads to probably the second part of this question, which is the most important part, is how to avoid getting into that situation in the first place. Yeah,
and I guess mistake it can be a harsh word, because no one means to make a mistake, do we? We can bash ourselves up and harm ourselves, or we can see, well, at least I had a go and it was a learning experience. And the key is that you do learn from it. Property investing or anything in life in general, realise that wasn't the best decision and I now understand why. It's one thing what you do about it, but most important is you don't repeat it, because that is a problem, isn't it? You haven't.
The second time is the mistake.
Yeah, you just haven't learnt.
The first time is the learning experience, is the school fees.
Absolutely. So there's no particular order here, but some common things, I guess, for investors to look for to avoid making mistakes. Don't confuse knowing your neighbourhood with knowing the market. An investor needs to see property as a financial instrument, and if you're not conscious of that when you're making an investment decision, you will be caught up in all the emotional things that come with property. You will be focusing on how it looks. You'll be focusing on what I call features and benefits, such as shops and cafes and train stations. They actually don't make properties grow. They've always been in the community, so if they made properties grow, property values would rise
in all communities.
In all communities every year. So they actually don't make things grow. It's important to understand the biggest influence on property markets is the economic side of things. whether an economy improves or declines will directly flow on to property markets. So that's what I mean by see property as a financial instrument. You need to think more like more like a share investor than a property buyer or a homeowner. And that's not going to happen overnight. That's a mindset. It's a profession, really. It's not a hobby. That's what we do.
Yeah, it's that golden line, isn't it, between home and investor, and the emotional attachment that you have to a home, and as you say, the economic attachment or the economic consideration that you give to a property as an investor. You're thinking about it in a completely different way.
Yeah. Some others, personally, I avoid anything new. It doesn't matter what town or city it's located in. The marketeers of the world are fantastic at convincing you that this is the one. As an investor, you've got 10 million residential properties in this country. It will be an absolute miracle if some spruiker happens to have the best one for you. But if it's new, the purchase price will be loaded with all sorts of taxes. The Housing Industry Australia say that about 40% of a purchase price for that first-time buyer are taxes. Right, so you're behind the eight ball from day one. It's like buying a brand new car versus a demo model. We know the demo model's really new, but it's a lot cheaper.
Yeah, that puts into perspective. What did you say the number was? 10 million properties?
10 million properties in Australia.
Yeah.
So again, see property as a financial instrument and go through a structured process to find one out of those 10 million.
Yeah.
The key to that is start with the various states, drill down to various local government authorities, then specific streets within that local government authority, and then an individual property within it.
So you're putting those filters in?
Yeah. Process of elimination. It's a bit like a search engine.
Yeah.
Don't place great reliance on aesthetics, how a property looks. Understand market cycles. Buy in anticipation of a market about to grow, not when you're already in the middle of a growth cycle, or the example I used earlier, right at the very end. There's some basic things. So
not to buy at the end of the life cycle, as you say. Hey, thanks, Simon. Thanks for coming along. Now, if anyone wants to learn more about what we've talked about today or Propertyology, how do they get hold of you?
Propertyology.com.au or 1300 65 40 70. Propertyology's point of difference, we analyse markets literally all over Australia, and we invest literally all over Australia.
Thank you, Simon.
Thank you.
Our second guest on the show today is Sally Dale. Now, Sally is the New South Wales and Queensland State Director at Opteon Solutions. Hello, Sally. How are you? And thanks for joining us.
Hi, Tim. Thanks for having me.
You are very welcome. Now, today we're talking SMSFs and specifically SMSF valuations. It is a fact, if you have property assets in an SMSF, or if you're advising clients that do, then valuations are going to be important. Isn't that right, Sally?
That's correct. And the ATO have a lot of guidelines around when and why you need to have a valuation. So if anyone's unsure, go and have a look at their website. It goes into it in quite some detail.
Let's explore that a little bit. I mean, there would be specific times of the year when valuations would be more important than at other times, probably around tax time, I would imagine.
Definitely around tax time. And your self-managed super fund manager will require you to list the value of your assets in your self-managed super fund, but also your auditor will require those details.
Now, there's differences, aren't there, between valuations? Valuations are not just valuations. There's some that are qualified and detailed, and there are others that are different. Talk us a little bit through those different options that people have.
If you want to get if you require a valuation from a qualified valuer, and again, go on the website at the ATO and have a look at the rules. But there's full valuations. That's when the valuer will come out and do a full inspection and provide you a full long report. Goes into a lot of depth. But also in some instances, we can give you an analysed market assessment, which is a desktop. The valuer may not need to come out to the property. They'll look at online information, maps, and some other details that you will provide. And that is a much more cost-effective option.
And does that one work for the ATO as well?
That will work for the ATO. Again, just depends on the requirements. Sometimes you will require a full valuation and sometimes you won't.
And this is just for tax purposes. And so it's not about if the value comes under or if it goes over. It's just a case of what is the valuation in terms of reporting on.
It's purely for tax purposes.
Is there any time outside of tax time when it's advisable? Would you advise people to get valuations done?
If you're transferring property within your self-managed super fund to related parties, you must get a valuation done, and that's not just for tax purposes. It's also a state government requirement for stamp duty. Generally, though, valuations are required for self-managed super funds largely around tax time.
Okay, and I just wanted to explore, just while I've got you here, just around, you talked about those very qualified ones and then the desktop valuations.
Yep.
Just how does that look in the real world, as it were?
Depending on the rules, definitely when you're transferring between related parties, you have to get the full valuation done. There's, as I said, strict rules around that. Most other instances, though, you can get the desktop, or it can be a valuation done by a qualified expert.
And that full valuation, so that requires an expert to go out to the property and walk through the property?
That's correct. They'd need to be a fully qualified valuer, so they would have qualifications. They'd more than likely be a member of the Australian Property Institute. In WA and Queensland, they'll be registered with the state body. So the full valuation, they're fully qualified valuers, not real estate agents, not a property expert per se. It's a fully registered or qualified valuer.
So these guys have got their tickets, and when they go out to the property, what are some of the things that they're looking for?
First of all, they'll look at the land size, the topography, location. They'll look at the improvements, the condition of the improvements, ancillary improvements, proximity to services, things like environmental hazards, power lines, everything related to that individual property and its location. So
it's not just what the property looks like and the state of the walls and the roof and the tiles and the carpets and things like that. It's the impact of where it is in the geography.
Definitely, and zoning and council requirements, all the statutory requirements that go along with the property as well.
It sounds like it's pretty comprehensive and probably comes with a big dollar value ticket as well, which is probably why the desktop valuation is a lot more cost effective. Does it match up though? Is it something that is equally as reliable?
Yep. The desktop valuation is carried out by a valuer that's in the local area. So at Opteon, we've got 550 valuers around Australia. So the person that's going to be doing your desktop is in your market every day, doing valuations for banks or for solicitors, accountants. So they know that market. So it is pretty accurate. So
it's a little less expensive, but it's just as accurate and just as reliable.
Pretty much,
just about. Hey, Sally, thanks very much for coming in and joining us today. Now, if anybody wants to learn more about Opteon Solutions and anything that we've chatted about today, how do they get hold of you?
Well, they could give us a call. Our phone number is 1300 40 50 60, or they can log on to our website, which is opteonsolutions.com.
Nice one, Sally. Thanks very much.
Great. Thanks,
Cheers.
Tim.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.